We do always like to start off the show with a summary of what we saw happening in the market this week. And it's been a pretty incredible week, actually. Even if we just go back, we have to include the weekend now because one of the banks that actually was closed on Sunday, of all places. So the Federal Reserve, the Treasury, everybody was busy this weekend. So, of course, last Thursday, Friday, Silicon Valley National Bank closed down. We'll talk about some of the reasons for that here as we go. And then Signature Bank closed on Sunday. And so it's interesting. If you look at the stock market there, you'd expect to see a much worse result. Yeah, I mean, we have had a drop that came down. You know, we peaked out about a month ago and kind of been bouncing along. We tested that trend line again, which isn't unusual. The trend line technically held there, and we bounced off of that. Kind of a normal-looking motion. Most of that downward motion was about inflation, the hot numbers that we started to get for inflation and jobs in January. And here we are, you know, with a market that's up a little bit. And let's talk about why. If we look at kind of the 5-minute chart for the week, it's an upward week. I mean, if you would have asked a lot of people at the beginning of the week, hey, these two banks have failed. There's rumors of other banks. We're starting to see the regional banking indexes dropping like a stone and all these things.
And it spread to international, too.
Eventually spread to Credit Suisse, you know, internationally. So, and here we are. We have an upward motion week. Now, you can see it's a pretty big roller coaster ride to get there. And so really what's happened is that the federal government and the Swiss National Bank, in the Credit Suisse's case, have stepped forward with a program to be able to try to kind of backstop the deposits that are in these banks. So they let Silicon Valley Bank close, they let Signature Bank close, the shareholders in those institutions and the people that had bonds, you know, of those institutions pretty much got wiped out. But all the depositors were made whole. And this was kind of an important component because so many of the depositors, especially at the Silicon Valley National Bank, had more than $250,000. What was the amount that you looked up?
So because Silicon Valley Bank caters so heavily to startups and tech-centric firms in the Bay Area, 90% of their depositors were above the $250,000 insurance limit.
Yeah, so there was some great consternation there as to what was happening. And again, if we would have taken a survey at the beginning of the week after these things have happened, you know, on the late last week and over the weekend, wouldn't have guessed that the market would go up. And so this is a really important component I want to make sure I cover, because one of the things that happens when you're looking at, you know, investing is that there's really kind of two ways to do it. One is you make some type of projection. Okay, the market's going to go down because of this banking crisis. So I'm going to react to that projection and I'm going to reduce my exposure, or whatever it might be. And so most of the articles that you read out there are about projections. It's what we all want. We all want the crystal ball. We want to find out, you know, when something's going to happen. I get asked all the time in our appointments, you know, what do you think about this or that? And the second methodology really for investing, in my opinion, is kind of a reaction. All right. So what I do is I look at the price and we react to that price. So in other words, as the market moves and that price changes, we're reacting to that. The concept behind that is that the information is in the price. So last week, markets coming down, find out at the end of the week, you know, maybe Silicon Valley Bank was part of the reason it was coming down even in the beginning of the week. This year, markets going up because the governments have been backstopping these banks. And so that's very hard to predict. And the reason that predict investing tends to do poorly is because most predictions are incorrect. And so our success has come from kind of watching, you know, day by day, minute by minute, and reacting to what happens and what happens with the price. And so we'll talk about our signals and how that works and how our triggers work here in a moment, because I've been asked to, you know, to try to communicate more effectively, you know, what our triggers, you know, are at this point in time. And I use a, you know, red, green, yellow light system within the practice to kind of do that. So, but let's just talk about the banks for a second here and what's going on. So Silicon Valley Bank had a lot of longer term bonds, okay? Last year was a horrible bond market, one of the worst ever. I mean, really, going back, like the 10-year Treasury last year had as much drop as it did the last time it happened was 1788. So that's kind of amazing. So what happens for a bank is they have this capital requirement. They take your money in, different lengths of time, but mostly shorter term, checkings and savings and all those things. And then they basically put their money out longer term. They'll lend it out as a mortgage, or they'll buy bonds. Mm-hmm. And so, they'll buy a 10-year Treasury bond, even though the money that you have in your checking account, you could get out tomorrow. And so that's where the banks can get a little shaky sometimes. But they're required to have a certain amount of money on hand, the capital requirement. And so they look at the value of those bonds. And when the value drops substantially, all of a sudden they need more capital. And that's exactly what's been happening since the beginning of last year. Is they've been fighting interest rates. The value of these bonds have been dropping. And so what they call par value is $1,000. So essentially what that means is if you buy it brand new, new issue bond, you'd pay $1,000. It can change in price. At the end of the time, maturity date, you get back your $1,000. And in between times, you've made this interest.
Yep.
Okay? So that's the basics. So in between times, the values have been dropping. The banks are still required to make up that differential, and they can't wait for it to come due 10 years from now. And so Silicon Valley Bank decided that they would make up the capital by issuing some stock. Unfortunately, that just notified Wall Street that they were having a problem. And of course, they're plugged in with a lot of venture capitalists because here we are in Silicon Valley, and there were several of them that recommended to their clients, hey, maybe you want to get your money out of Silicon Valley Bank, and they had a run on the bank essentially, and they ended up having to, the feds ended up having to seize it.
Yeah, it's kind of like when you think about it, a gym. We have, a gym may have like 1,000 memberships, but if everyone goes at the same time, the gym doesn't work anymore. And the bank is a very similar idea. Is if everyone pulls their money at the same time, they don't have the money anymore. So they keep a certain percentage. Let's say the percentage is 10, and so then they use that money. They keep 10% of your deposits, and then they kind of use it for investments or loan it out to someone else, and it kind of multiplies the money. And so all the banks do it. They lend out money, and the system is built around trust that you can get your money out.
Yeah, exactly, and that was the big deal, because what happened here is although they closed those two banks, there were other banks that were struggling, and so the Fed, the Treasury, and the FDIC got together over the weekend and created this fund. And they used, it's called the deposit insurance. I won't get too much into that, but what happens is that they decided to kind of backstop those two institutions specifically. They said, even if you have more than $250,000, we're going to give you your money back. That was a big deal. Some of the companies here in the Valley had a lot of money at the bank. They want to get that back. But what they did is they opened up a scenario for the rest of the banks where they can borrow fairly easily. So in that way, they don't have to run off to the stock market and notify everybody that they're in trouble. They can borrow, and as collateral, they can take their bonds, which have now come down in value. So if $1,000 was par, maybe it's worth $800. They can use the $1,000 par value as the collateral for the loan. Because what's happened is these banks, this is theoretically temporary, right? Mm-hmm. It's worth $800 now, but once it comes due, it'll be worth $1,000. So the Fed is going to lend that money out to fill that gap, and then that kind of gives that liquidity to those banks. And so that's a really good thing. I think it's a pretty good idea, because it is a loan. It's not a giveaway, and it's not taxpayer money because they're using this bank insurance. So far, I think it's fairly well, thought through. And we did have one problem this week, and we saw some of the big run-up here that's just over my head actually happened because they kind of solved it. So First Republic Bank was really struggling, and the reason they were struggling is because they have a lot of municipal bonds. Well, municipal bonds weren't part of that backstop program that the Fed and Treasury and FDIC created. So they couldn't go there and lend money at par value for these bonds. So 12 banks got together and literally deposited $30 billion into First Republic. So that's good for them too, in a way. The money's still there theoretically. They're just putting liquidity in there, and that allows First Republic to then meet its capital requirements and have that cash on hand. So that's how they got around that. And so I think a couple of things that I think are really important here. Number one is lots of questions about, what about my money? I have $80,000 at this bank or at this credit union, and so if it's under 250,000, you're backed, right, by the government, and so that's important to understand at banks and credit unions. Now, ideally, you probably want to be at one that is doing better than another, just so there isn't some interruption, as far as that goes. But for the most part, that's going to be very difficult to tell. And right now, because they've got this lending capability, it does allow for quite a bit of liquidity to come into the banking system.
Yeah, and this bank run kind of came from fear that you wouldn't get your money out.
Yeah.
And so it's essentially because all these, the banks that are having trouble are the banks that kind of cater to people that keep more than 250,000 in their accounts. So if you have to do payroll for a startup, you're likely going to pay out more than 250,000 a month. So you have to keep that money on hand.
Yeah.
And so if the bank goes under, you lose that money. And
Yeah.
that's the big issue. And that's what caused that run.
That's right. Okay, so this brings us to the question that we were getting is like, what do we do about this, and how do we react to this, and how do we make sure that we're safe in this environment and all of these things? Because what's happening here is that this is bringing on the fear of what happened in 2008. And so a couple of things, and this is just my personal opinion, but 2008 is something I've studied tremendously. I lived through that. And what happened was we were bailing out, backstopping different institutions that were struggling during that environment. It was a much different environment. It wasn't an inflationary environment. It was literally a recessionary environment, which we're not in at this point in time. But they all of a sudden stopped backing one institution, and that was the Lehman Brothers. And there was a reason for that. They just bailed out Bear Stearns. All right, so they were working on it. The Treasury and Federal Reserve got together with the Lehman Brothers, and they were having a conflict. The CEO of Lehman Brothers wasn't doing what the Fed wanted them to do. And so they decided to let that one fail. What they didn't realize was that it was essentially a house of cards built on these credit default swaps and all these other things, and the market really fell. And so a couple things happened. First of all, there was roughly a 30% drop in the market after that. Nobody wants to see that again. Number two is the government did end up doing all kinds of stimulus. If you guys remember the TARP bills and those types of things, roughly $7 trillion was spent, kind of getting the economy going again after that big fall. Theoretically, they could have put out that $150 billion to Lehman and maybe avoided that. So that's kind of in the back of the mind right now. The other part is purely political. That transpired in an election year, presidential election year, and really swept the Republicans out at that point in time. Obama came in, Democrats controlled both, House and Senate at that point in time. And so here we are kind of heading into another election. We've got the White House who controls the Treasury, the Federal Reserve to a certain degree. I won't say control, but they all want the same thing here, which is to try to create this stability. So there's less chance of a 2008 scenario from happening right now, in my opinion. Now, it can happen. Something else can happen. Things can happen internationally that the U.S. can't control. So we did see this week inside of this chart here, matter of fact, part of this downturn that transpired was Credit Suisse, right? Huge bank. And been having trouble since 2015. 18, for a really long time. And so they have the Saudi National Bank is their biggest shareholder. They've been giving money to Credit Suisse to kind of help them out. Finally said, nope, we can't do any more. And that's when this downturn started that you see right here, kind of the middle of the week. And what happened was that the Swiss National Bank, basically their form of the Fed Reserve, offered to lend money, $54 billion, which is a lot of money. So that's interesting. And then today we have a downturn that's going on, right? There's a lot going on here. So the downturn that's happening today has to do with two things. Number one, today is Triple Witching Day. Okay, so this is the option expiration Friday, You generally can kind of ignore, in my opinion, some of the results that happen on these types of days, just because it is just such a weird environment and all these option expirations. We'll see what happens next week, really, if you want to kind of know. But there was one other thing. This lending program that the government set up, this week the banks went in there for $154 billion here in the U.S. That's the most ever. More than they took out in 2008 during that particular crisis. So that's making the market think, is this liquidity crisis bigger than we thought? It's not just, First Republic and Signature Bank and, Silicon Valley Bank. There's obviously other banks that are looking at this and saying, okay, hey, we need this liquidity also. Now, I've heard that there's up to $1 trillion, or read that there's up to $1 trillion that will be available. Again, there's a political will here to make this work and not have it turn into 2008, so we don't have more bailouts, so we don't have more change of party, right? I mean, maybe some of you want the party to change or they don't. Irregardless, that becomes part of the calculus as they're working through this. So I think that's all very interesting. The other thing to be aware of here at the end of the quarter, if you remember at the end of the year, I was talking a lot about the fact the market's coming down here at the end of the year because these big target date funds and pensions are rebalancing. Mm-hmm. They have a target for X amount in stock and X amount in bond on a simplified basis. And then they rebalance those at the end of the quarter. So if you look at from the middle of September to the end of September, the market dropped a lot. On October 1st, after the quarter's over, it started back up again. Here we went, the end of the year, dropped the last 2 weeks, and then January, we had a pretty nice run, yeah? And so here we are again. We're at the end of the quarter, and so what happens is, it depends on what happens between the disparity between stocks and bonds. There hasn't been as much disparity this quarter. It might not have as much impact, but you have to be very careful with what you're looking at right now between triple witching options expiration and the last 2 weeks of the quarter's rebalancings that are happening. Be careful of making massive assumptions about where the market might be going here, whether that's up or down, because you can get these kind of convoluted data points that happen. So that's what's been happening. That kind of describes all the pieces. There's an awful lot going on this week. It's worth looking at. I would say, I'm feeling okay about a 2008 type contagion at the moment. The market is too. You can see that because it's up. And obviously, if you have under 250,000 in these institutions, then that's not a bad thing either. You should be okay. You've got a backstop from the government as far as that goes. So now I want to talk about kind of something that was asked of me, which is just, can you please communicate in some format, where your thought process is on different aspects of the market? And so I've made it, and this is wildly simplified, but what I've done here is I've got a green, a yellow, and a red light system. And I'm going to put this up every week and show you where we are. And I'm going to also put this into my daily videos. So if you want to see day by day, whether these signals are changing, you can watch the daily videos that I put out. We started doing the daily videos on the 22nd of March, 2020. And we did it because the market was falling apart and clients were getting nervous, and I was just trying to show some of the positive things that were happening at that time. Turned out that the next day was the low for the year, which was the 23rd of March. So we've been doing this for almost 3 years. I probably miss maybe 15 days a year, so we put over 240 videos a year out. So you can watch those, and I'll start incorporating these signals in there. And so, very simply, if it's green, then we want to be in the market. And we really want to look for things that are having great momentum right then, maybe even outperform the market on that upward run, and we want to kind of go with that. If it is yellow, we actually want to reduce the risk of the holdings, still want to stay in the market. Maybe we're using utility stocks or consumer staples or high dividend stocks, and still staying in. Mm-hmm. If it is red, then we really want to reduce the exposure to the stock or bond market and move more towards like a T-bill type ETFs and those types of things, okay? So there's two trigger speeds. One is fast and one is slow. So we actually have two programs. So the fast one is ideal for the IRAs, the Roth IRAs, and those types of things. Historically and in back testing, we have higher rate of returns out of our faster triggers than our slower triggers, but it creates a lot more transactions. So the slower triggers are designed more for those taxable accounts where you don't want a lot of transactions, you don't want a lot of tax consequences if possible, and you don't want to have to record all those on your tax return, right? In both cases, we do not have commissions any longer to buy and sell these ETFs, so it's kind of nice, but the tax consequences for that taxable account is why we have that slower trigger. And then there's, of course, two asset classes, stock and bond. And so what it looks like is this. So here's our current signals right now, okay? Our faster trigger is green for stock and green for bond. So we're fully invested in our IRAs and Roth IRAs. We got that trigger on Tuesday, okay? Turned out okay, market was up. Again, we're reacting. These lights turn on and basically are reacting to what's happening within the market. We're not predicting what's going to happen. Otherwise, we probably would have been out of the market after this weekend because of the bank's failure and what have you. So now things can change, things could get worse. Those could turn red pretty quickly, okay, because it's a faster trigger. The slower trigger, actually the stock is red right now, and the bond is still green. And so on the slower trigger, these are taxable accounts. We will be moving, as long as it stays red, slowly but surely towards T-bills. Now, we have secondary issues, and again, I'm giving you a very simplified look at this, and we haven't made much changes yet because the market is going up, right? It's been up for most of the week, and so we need to see a little bit of deterioration in the current time frame to go with that trigger before we do something. And again, we're trying to reduce exposure to the number of transactions in the slower trigger. So again, these are things that will broadcast across the bottom of the show on a regular basis. You'll see that come up. And then I'll put that into the daily videos also. If you want to watch those, you can kind of see what's going on. But again, for all the consternation that's out there, 3 out of the 4 scenarios right now that we have are green, right? So I think that's important to understand. Again, we'll show it to you day by day so you can see how that changes. All right. The last piece here is just the 2-year Treasury note. And so, that's the wrong chart. I'll switch back to our two-person base. Just talk about the 2-year Treasury note. So not that long ago, about a week and a half ago, it was hitting 5.1% on the yield. It got all the way down to 3.8%. Mm-hmm. Right now it's sitting around 3.94%. And so there's a couple things that are really significant there that I think are good for the stock market and good for the banking system. Number one is because of the kind of the fear of, what might happen to the economy, you started to see people dumping money into treasuries. Because that is one way, if you don't want to have your money in the bank, you can directly buy a U.S. Treasury through brokerage firm. We can set that up for people, and we have in the past. And what happens then is when there's a bunch of buying, the price of the treasuries go up, and the yield comes down. Mm-hmm. They go in the opposite direction. And so think about that for a second and why that's important. Number one, the price of treasuries is going up. The banks are struggling because the prices have come down so much. They require this bigger capital requirement to meet their capital requirement needs. As the bonds start coming back up, there'll be less need. So that will help actually, at least in the short term here, support the banking system. The second thing is that it creates a lower competition for the stock market. When you can get 5.1% on a 2-year Treasury versus an 11% average stock market return, more money is going to go towards treasuries and those types of things than there is the stock market. And so that is a problem for the stock market. But when the rates come back down, the stock market has more money that might come back. Because again, I get 3.9 or I can make more money long term in the stock market. That's the theory, right? So both of those are actually pretty positive, and I think that's a really big development right now that's been going on too. So it's a very, very interesting time frame. We have to wait and kind of see what happens and see how these things play out. But again, I think one of the things to keep your mind on is that the U.S. and the rest of the world was able to kind of put out enough stimulus money to stop the possible depression that would have happened from the 2020 shutdown worldwide. airline miles dropped by 96%. All these things were happening. Restaurants were closed. And they not only managed to keep us out of a depression, they actually probably put out too much money. And they were able to turn around the economy, eventually, but the stock market just took off, right? It was a fantastic year for the market. And I think that there's enough will out there to continue to support this banking system here. If they have enough capabilities to get us out of the pandemic, they have enough capabilities to do it here. Long term, that's going to be interesting, right? I worry about the long term aspect of these types of kind of bailouts and backstops that are happening. But right now, in the short term, I think that we're okay as far as that goes. Let's just watch and see how this plays out. We'll need to watch what's going on internationally, those types of things too, and see how it plays. But very interesting time frame. I'm super glad that you could join us today and be able to kind of see, what's going on, and we'll be able to, meet with you again next week and cover this again. Thank you.